We're building something here, a complete journey into algorithmic trading from the very basics all the way to a professional level. If you're looking for shortcuts, quick profits, or easy money, this is not for you, because this series is about depth. About understanding, not guessing. We're going to build your foundation, then take you to the intermediate level and eventually turn you into a disciplined, system-driven trader. And no, this doesn't happen overnight. So if you're serious, if you're ready to learn this the right way, hit that subscribe button. Today is day 10. Let's continue the journey. Welcome back. If you've followed the series till now, you've already built a strong foundation. But today we move into something that decides whether you survive or disappear from the market. Risk management. The most ignored yet most important part of trading. Not your strategy, not your indicators, but how you manage risk decides your long-term success. Think of trading like a game of survival. If you lose all your capital, the game is over. No matter how good your strategy is, you don't get a second chance. Imagine you walk into a casino and you bet everything on one round. That's not strategy, that's gambling. Most retail traders do exactly this without realizing it. So let's start with the most important rule: risk per trade. Professional traders risk only a small percentage of their capital on each trade, usually 1% or less. Let's say you have a $1,000 account. 1% of that is $10. That means no matter what happens, you lose only $10 on a single trade. Now think about this: even if you lose 10 trades in a row, you still have most of your capital left. That's the power of controlled risk. Next concept: stop loss. This is your predefined exit when the trade goes wrong. In algorithmic trading, this is not optional, it's mandatory. Your algorithm must define risk before entering the trade. Entry, stop loss, and position size all calculated in advance. No emotions, no last-minute decisions. Now let's talk about risk-reward ratio. This defines how much you risk versus how much you aim to gain. For example, risking 1 to make 2 gives you a 1:2 ratio. Here's the interesting part: you don't need to win every trade. With a good risk-reward ratio, even a 40% win rate can be profitable. Position sizing is where everything connects. This decides how many lots or units you trade based on your risk. It ensures that every trade follows your 1% rule. In algorithmic trading, risk management is not a suggestion, it is coded into the system. Every trade follows the same rules without deviation. Humans break rules under pressure. Algorithms don't. That's why combining strategy with strict risk management creates consistency. So today you learned risk per trade, stop loss, risk-reward ratio, and position sizing. This is your survival framework in trading. If this video added value in your life, hit the like button, subscribe to the channel, and share it with your friends.